Hey everybody, thanks for watching. Wanted to do a video on how we can follow put riders in flow without buying naked directional calls necessarily. Sometimes you'll see put riders get 100% on their trade and calls get burned up just because the stock is range bound or only moves up so much within a certain time frame. And this is really the more accurate way to follow put riders or call riders for that matter. We are going to focus more on put credit spreads now, but all this is applicable to call credit spreads, call riders as well. So the examples I give, how they work, are all exactly the same. But we're just going to focus on put credits today. So, what is the advantage of doing a credit spread over naked put right or calls? So, it allows you to collect a premium just like a put rider without needing the collateral of cash or margin to take assignment of shares. So selling one put gives you the right to own 100 shares of the underlying if that put is assigned or goes in the money or expires in the money. Buying Doing a credit spread and buying another option as collateral takes that assignment need away for the most part. It also puts theta and decay in your favor if a stock is range bound or isn't moving one way or the other in a big direction. It's actually good for these spreads because you want these spreads to decay and go worthless for your max gain. When we have not that the VIX is incredibly high right now, but when we have environments like this where the market pulls back and VIX is elevated, premiums get elevated, and you can take advantage of this by selling premium as premiums are higher during these times. You can completely define your risk up front. The max risk you take on based on the spread you sell is the max risk if the trade goes completely against you. You can adjust this based on how wide of legs you're selling on the spread. So the credit you receive or the premium you receive is the difference between the contract you sell and the contract you buy. So if you sell a contract for $200 and you buy a contract for $100 as collateral, the difference is $100. That would be the money you would receive on the credit sale. The max risk of the trade is the difference between the strike values you sell and the premium you received. So I've typed up an example here for you. Let's say you sell a 250 put for Apple for $200. You buy a 245 put as collateral for $50. So the credit you would receive is 150. That's the difference between 250. And then your max risk is defined by the difference between the spreads that you sold. So you sold a 250, you bought a 245. That's a $5 difference. So $500. Then you would take out the credit you receive, which is 150. So 350 would be your max risk there. So you're risking 350 to make 150 in this example, which is a 43% return on your cash risk if the spread expires worthless. Now this isn't as sexy as a naked call, obviously that can go thousands of percents. But when a higher VIX environment like this, if you do see the market bounce, you'll see premium drain out of the contracts. So this is bad for your naked calls, especially if they're short dated. You won't see the premium increase like you normally would, especially on very short dated stuff. And it actually benefits credit spreads. If you sell credit into a higher VIX spike and then the VIX drains, you'll see your credit spreads go into profit much quicker. So the closer to the money that you sell these spreads, the more premium you receive. There is less initial theta selling at the money, and there is a higher probability of the contracts not being out of the money at the end of expiration if you sell right at the money. The further out of the money you go, the less premium you'll receive. However, the odds of them expiring worthless are greater. So there's kind of a teetering scale that you kind of have to balance for whatever your style of trading is or whatever makes sense to you when you risk these spreads. You can also sell wider leg spreads or spreads closer together. The wider you your spread, like the difference between the strike you buy and sell, the more premium you receive. However, there is more risk involved, the higher risk there. Why are these spreads good? Well, they're good for when a name is range bound. If something is ping ponging between a $5 to $10 range on the daily or weekly and doesn't seem to want to break out of it, when it comes down to support, you could sell these spreads instead of buying calls if it's choppy. A name breaking out or trending up, you could also sell spreads on like this. It's not going to be, a sexy call gain like we discussed before. However, it's a great way to generate income on a name that's trending up. When it dips, pull back to trend, you could sell these spreads against it for more passive income. Or a stock you like is coming into a support area, say it has a bad earnings, there's a headline. Instead of just buying calls trying to knife catch a big dip, you could sell these spreads. And also the advantage to these is for earnings. Instead of buying a naked call, let's say the stock goes up $10, your call still is worthless the next day. But if you sold a credit spread, then you would probably collect a large premium once all the IV drains out the next day from the earnings being out. So that's the gist of them. I'm going to run through a couple actual calculations here for you, just so you have like a real world example right now of what this would look like. So we're just going to do Apple for next week, and then I'll do one that's further out so you can kind of see the difference. But let's say Apple, you sold an at the money spread for next week. Credit spread, you sold a 245 put, and then you're going to buy a 242 half put back as your collateral. So we would sell right here, you sell in the bid, right? So you would sell the 245 for $257. You would buy the 242 half put at the ask for $1.80. So 257 minus 180. You would collect $77 in premium on this trade. Your max risk is 245 minus 242 half. So that's $250. So 250 minus 77 premium collected, $173 is your max risk. So you're making $77 against 173. So you're making about 44.5% of your money on this trade if this trade expires worthless. If Apple is at 245.55 Friday, if it's at 245.55 this coming Friday, congrats, you've made the entire premium here for Apple doing absolutely nothing. Saying Apple can just trade sideways all week. Now let's do a wider leg example. So we'll sell a 245 put and we'll buy a 235 put as collateral. So instead of a $2.50 spread, we'll go to a 10 just to show you the difference. So you sell the 245 for $257, and we're going to buy back the 235 here for 56, so minus 56. So you're collecting $201 on this trade, so a lot more than our last example, but let's look at the risk now. So you just sold a $10 wide leg spread here. So now your risk is $1,000, right? $1 is 100, so 10 is 1,000. So your max risk is 1,000 minus the premium collected. $799 is your max risk now. So instead of risking $173, you're now risking $800 to collect 201. Now what is the percentage on this? 201 minus 799. I'm sorry, divided by 799. So you're only making 25% of the money risk now. So you can see that, yes, you collect a greater amount of money or capital on the premium on the spread sold, but you now have a higher risk and you're making less money for that risk on a percent basis. Now, if you sold something like much further out of the money with a tighter spread, you could sell at 235 and buy at 230. And that would be, so you collect $54 for the 235, you sell that on the bid, you would buy the 230 for 30 cents on the ask. So minus 30, so you're making $24. The difference in the spread is 500 minus 24. So you're risking $476 to make 24 bucks. Now, why is this spread so? Why are you not getting any premium here? Because the spread is so far out of the money. For Apple, a $10 move is rather large. So the odds of this expiring worthless are much greater than selling up here. So you're not getting as much premium for selling these. So you're only making, what, 24 divided by 476, making 5% of your money there. So not a great return. Has a higher probability of working. Obviously, you could sell multiple contracts, but you do have to look at what you're risking if Apple was to, let's say, have a bad headline and drop significantly. So that's what selling weeklies would look like. If we came and sold April monthlies, it's going to be the same thing. But I'll just show you the difference here. So we don't have 2.5 spreads anymore. We just have 5. So we'll sell an at the money spread. So we'll sell the 245 for $735. We'll buy a 240 for $560. So $175 in credit received minus the difference of $500. So 500 minus 175. So you're risking 325 to make 175. So as far as percentage wise goes, you're making a very high percentage on your money comparative to the weeklies, and then you have more time for this to work out and decay versus like if Apple drops significantly this week, your weekly put credit spread would be screwed, but if Apple recovers in the next week or two, like these would decay very nicely. So hopefully that paints a picture for you. You can understand the difference of like what you're risking, how to kind of put these together based on your risk tolerance. Obviously, you can sell multiple spreads here at a time. You could buy back. Let's say you sell a put credit spread and it goes down, and your bought to open leg isn't a huge profit. You could buy that back and then take assignment of shares, or you could buy that back and roll it to a different strike and like recreate a different spread. So there's a lot of things you can do with this once you're open to this. But hopefully this helps and kind of gives you an idea of what you can do following put riders versus just buying naked calls. You may not have to have a certain level of margin turned on for this, but people think spreads are like way more complicated and risky. They're really not. They're actually less risky because you can completely define the risk up front and actually put like decaying options in your favor. So hope this helps. If you have any questions, let me know. I'll be happy to go over more for you. But thanks for watching.